Welcome to The Explainer. Today, we're pulling back the curtain on the hidden, high-stakes architecture of global money movement. Literally trillions of dollars zip across the globe electronically every single day. I mean, it's the absolute lifeblood of international commerce, right? But it's also a landscape completely fraught with massive regulatory challenges, incredibly sophisticated financial crime, and this sort of ongoing arms race between regulators and bad actors. We're going to break down exactly how these wire transfers work, the critical risks they carry when it comes to money laundering, sanctions, and fraud, and the intensely complex regulatory control frameworks built to keep the whole shebang from being weaponized. Let's get into it. So, to ground this, think about your own life for a second. Let's say you're wiring a down payment on a house, or maybe sending money to family overseas. You open an app, or you walk into a bank, you authorize a payment, and you just hit send. But where does your money actually go when you hit send? We constantly throw around acronyms like BSA, AML, and FATF, but behind all that jargon is a real physical and digital reality. Your funds don't just magically teleport, right? They're routed through a highly specific series of institutional handoffs. And understanding that hidden chain? Well, that's really the only way to understand how criminals try to exploit it, and exactly how banks are forced to defend it. Okay, let's look at our roadmap for today. First, what is a wire transfer? Second, the need for speed. Third, the financial crime playbook. Fourth, following the digital trail. And finally, building a defensive framework. Section 1. What is a wire transfer? Before we can dive into the risks, we have to establish exactly what we're looking at from a strict regulatory perspective. The terminology here absolutely matters because it defines who is legally responsible at every single step of the journey. Under the U.S. Bank Secrecy Act and anti-money laundering frameworks, as well as guidance from FATF, a wire transfer isn't just one simple leap of money. It's actually defined as an electronic transfer of funds sent through a system from an originator to a beneficiary. The crucial takeaway here is that it represents a whole series of transactions. It starts with the originator's payment order, and it only ends when the beneficiary's bank formally accepts a payment order for the benefit of the ultimate receiver. It's basically a chain of liability, and it's a chain that frequently crosses multiple institutions and national borders. Moving on to Section 2, the need for speed. Now, this is where the reality of modern global financial networks really comes into play. The sheer velocity at which this chain of transactions happens is just staggering. Wire transfers are the absolute workhorses for moving massive value quickly across jurisdictions. They are completely central to legitimate global treasury activity. But that incredible speed is exactly what creates the danger. Listen to this frankly chilling quote from the Federal Reserve regarding their Fedwire funds service. They state that because Fedwire is a real-time gross settlement system, funds transfers are immediate, final, and irrevocable once processed. Immediate, final, irrevocable. I mean, let that sink in for a second. This brilliantly illustrates why upstream controls, the checks done before you ever hit send, are quite literally a matter of life and death for financial institutions. There is absolutely no undo button once that settlement actually occurs. So we're left with this really intense tension. On one hand, we have massive utility, efficient, borderless, lightning-fast movement of funds that is just essential for commerce. But that exact same infrastructure creates towering risks. Because wires often involve intermediary banks and multiple hops along the way, the data can get degraded. And incomplete or poor quality information, especially regarding who exactly is sending or receiving the cash, can dramatically weaken sanction screening and transaction monitoring. When data is poor, routing becomes obscured, and fraud can be executed at breathtaking speed. Which brings us to Section 3, the financial crime playbook. Let's look at this forensically for a minute. Because criminals are incredibly aware of this system's speed and its vulnerabilities, they've developed highly specific methods to exploit it. In the financial crime environment, wires are uniquely dangerous because they accelerate all three of the classic stages of money laundering. First, they act as a super-fast vehicle for placement, getting illicit cash into the system. Next, they aggressively bounce those funds across borders and institutions for layering, which is intentionally designed to confuse auditors and disguise the illegal source. And finally, they seamlessly handle integration, where the washed money is wired right back into the legitimate economy to buy things like real estate or luxury goods. It's like a highly coordinated, high-speed shell game. And regulators absolutely know this is happening. The FFIEC actually explicitly publishes red flag materials to help banks spot this exact behavior. They are actively hunting for specific indicators, things like wire transfers heading to or from well-known secrecy havens, funds routing needlessly through higher-risk jurisdictions, or transactions moving massive sums through intermediaries without any apparent logical business reason. Criminals use these tactics specifically to obscure the real parties involved in the transaction. I really want to remind you of the stakes here. Like we talked about, once settlement occurs, the opportunities to stop a loss or recover those funds are dramatically narrowed. Whether it's a money laundering syndicate washing proceeds or a fraudster who just compromised a corporate account and is draining it at lightning speed, those upstream preventative controls are quite literally the only thing standing between legitimate funds and a total loss.
All right, Section 4, following the digital trail. Now, what's really interesting about this is how regulators respond. If the risk is anonymity at speed, the regulatory countermeasure is mandated transparency. Basically, every wire needs to act like a digital postcard that everyone in the chain can easily read. And from a professional compliance perspective, that brings us to the absolute global cornerstone, FATF Recommendation 16. This recommendation explicitly mandates that wire transfers must carry detailed originator and beneficiary information. This ensures that every single firm and authority along that chain can clearly identify who is sending and receiving the funds, and can actively assess whether the transaction is legitimate, suspicious, or, strictly prohibited by sanctions.
And hey, this isn't some dusty, outdated rulebook we're talking about here. Payment transparency is a fiercely active control issue. In fact, FATF just updated Recommendation 16 in June 2025. They actually had to revise the framework specifically to keep pace with rapid changes in the modern payment domain and completely new, evolving risk typologies. Regulators are constantly trying to ensure this digital postcard doesn't get shredded as payment infrastructures become more and more complex. Section 5. Building a defensive framework. Let's see how this all comes together. So how do financial institutions actually implement all of these rules to handle the intense pressure of speed, scale, and finality? Well, it requires a really mature, overlapping control framework where several elements work flawlessly in tandem. First, you absolutely need rock-solid, reliable originator and beneficiary data. That's that FATF 16 requirement we just discussed. Second, instantaneous, real-time sanctions and payment screening. Third, deep customer and counterparty understanding. You really have to know who you're doing business with. Fourth, robust post-event transaction monitoring to catch weird patterns over time. And finally, strong, immediate escalation procedures for when payment activity is suddenly wildly inconsistent with a customer's known business purpose. Because in the financial crime environment, the question is never whether wire transfers are inherently suspicious. They aren't. They're an essential part of finance. The real question is whether an institution can truly understand and control the immense risks created by their speed and reach. Which leaves us with this final, really important thought. As international commerce pushes for even faster, more frictionless real-time payments, the tension between utility and risk is only going to amplify. As money moves faster than ever, is your institution truly controlling the risk or just trying to keep up? It's a question every compliance officer, banking executive, and regulator has to wake up and answer every single day. Thanks so much for joining me for this explainer on wire transfer risks. I'll catch you next time.